Hello and welcome to Raise Your Average. I'm Pierre Daly, managing editor at advisoranalyst.com. My co-host is Adam Butler of Resolve Asset Management Global. And joining us today are Jon Aikman and Dr. Sean Cleary. Our conversation will revolve around the controversial intended and unintended consequences of sustainable finance and ESG, and all of its corresponding aliases: impact investing, SRI, green, or whichever ESG term you like. Jon Aikman is president and CIO at Resolution Investments. He's also the founder of an artificial intelligence consulting firm, Nord AI Analytics, started in 2019. Previously, Jon was CIO and portfolio manager at Pinnacle Wealth Brokers and was the winner of the Portfolio Management Association of Canada Award for Performance in 2018. Jon has a law degree from Queen's University, an MBA from the University of Oxford, and has completed advanced certificates on artificial intelligence and fintech from MIT. Jon is a chartered investment manager and qualified lawyer in Ontario, England, and Wales. Dr. Sean Cleary is the executive director of the newly established Institute for Sustainable Finance based at the Smith School of Business at Queen's University, as well as the founder and director of the Master of Finance program. He holds a PhD in finance from the University of Toronto, an MBA, and the Institute of Corporate Directors designation. He is a CFA charter holder and is a current member of the CFA Society Toronto Advisory Council and a former member of the board of directors of the Toronto CFA Society and the Atlantic Canada CFA Society, where he was serving as president.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of advisoranalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Jon Aikman, Dr. Sean Cleary, welcome to the show. It's great to have you both and very excited to chat with you today.
Thanks very much.
Thanks. Happy to be here.
There's a lot of pedigree on the channel today.
There certainly is.
We got to be on our best behavior.
There certainly is. So to kick things off, why don't you both give us a little bit about your background and how you ultimately got to the sustainable finance space and what you're up to these days.
Sure, Sean. Why don't I start? You're more interesting than me, so I'll dull everyone down right now. But I guess my start to finance. Obviously, I began as a lawyer, and I went overseas, went to London, and started working for some of the large investment management firms. So I guess I've had a long interest in ESG before it was known as ESG. I guess we just started thinking about kind of moral investments in some ways a long time ago, which became socially responsible investments or different things like that. And that's developed in a big way to a number of different kind of categories of investment. So my experiences in studying impact investments, teaching as well at Queen's University in an impact investments course was a really an eye opener, and as well as investing as an investment manager running an alternative credit portfolio. You started to think about some of the larger issues and the sustainability issues that we have to confront today, because we have some really big and profound environmental and, as everyone knows, social and governance issues. So I guess I came at this from a little bit of a different perspective, but I've arrived in on the right time. And with that, I think that there are some really important investment decisions made and really interesting and attractive investments in ESG, whether we're just trying to avoid some of the foreseeable climate risks for the future, or we're trying to tackle certain other types of problems and look for good opportunities for the future. ESG is something that will be, I think, the story for the next 30 years is going to be the general trend about how we tackle some of these large issues like climate change, and how we invest is changing. So I also sit on part of a pension and endowment for a university, and that's really interesting to see the way institutional thinkers, institutional investors are thinking about investments for the future. Now, that said, I think that there are lots of things to discuss, and the ESG could create bubbles in certain sectors, for sure. But I do think that it is a major trend going forward, and it is really, really important that we get it right and pay attention to sustainable finance. So with that, I guess I turn it over to Dr. Cleary. I can tell you that he was wiser in this regard than in fact I was, that he was a forward thinker. And as I was grappling with the implications of artificial intelligence in finance, he was really focused on sustainable finance and is clearly a leader in Canada and internationally, and has written a lot, has spoken a lot on that. So for my part, I'm really glad that you're here today, and it's really great to see you and have your insights on sustainability. And congratulations on developing the ISF, which is a huge development for Canada globally on sustainability.
Well, thanks, John. It's like I feel like I should leave now on a high note.
You beat.
I appreciate all the kind words. And I would say it's been an interesting journey setting up the Institute for Sustainable Finance at Smith School of Business, Queen's University. So we formally launched just under 2 years ago, November 19th of 2019, but we were in the background working on things for about 3 years. And I think what's interesting, and you kind of touched upon it, is just the conversations that I have these days versus those that I had 2 to 3 years ago. So when we even started to set up the Institute for Sustainable Finance, I was on a call this morning, and the most common question I got asked was, how do you define sustainable finance, right? And I can say that I probably don't get asked that as often anymore, although it does tend to mean different things to different people, depending on their perspective. But it's really come charging into the mainstream. And I think it's affecting the ways that institutional investors are looking at things, because clearly they tend to have the longer tails, especially pensions. So they've probably been a little bit ahead of the curve in looking at these. But if you look at asset managers and the movements that are going on in the retail market too, these are questions that investors are asking their advisors. And also, if we're in the middle of a major transition, which we are, if we do get to net zero 2050 or whenever we get there, that's going to change the structure of a lot of industries and a lot of companies. And, as an investor, those are important trends to be aware of. You want to know the trend, and you want to identify where you want to be on that trend. Do you want to be ahead of it? Do you want to be on it? Or you certainly don't want to be too far behind it, right? So I think it's driving a lot of the conversations today. And the Institute for Sustainable Finance, I kind of forgot to mention what we are, but we were set up as Smith School of Business, but we're a collaborative hub spanning across academia, industry, and regulators, with the mission of promoting sustainable finance considerations in mainstream finance. And we pursue that mission on 4 pillars: research and education, which you normally associate with universities such as Smith School of Business, Queen's University, but also collaboration and outreach. Because these questions and getting the right questions and providing the right educational opportunities and focusing on the right research questions, because it's a growing area, requires a lot of conversations with others. And also part of the research and education is getting our research out there to people that are interested. So it's been a busy 3 years, and the momentum just seems to be growing in the area. And of course, Now I've kind of switched from mainstream finance to sustainable finance world. And now it's like everyone I talk to is talking about COP26 these days.
Yeah.
And it's interesting that a lot of the headlines in the newspaper are COP26 as well. So it's not just, 3 years ago, it might have been a page on page 7, B7 of the report on business, and now it's right on the front page. So I think that's reflective of the fact that people are recognizing it's very important.
So sustainable finance. Obviously, I think people are starting to gain a better understanding of what it means to think sustainably. But I'm curious about how you sort of map the Venn diagram between sustainable priorities and finance. I mean, obviously, finance traditionally has been about raising capital and allocating capital to productive projects. So how do you guys see the ISF in terms of, bringing together best practices in sustainability with what is traditionally a fairly conservative sector like finance?
Yeah, that's a great question. And I think there's Canadian expert panel for sustainable finance was convened in 2019, and Tiff Mecklem was one of the 4 members on there, and Andy Chisholm and Barb's Van, who are both on our advisory board, were 2 of the other 3 members. So they had what I thought, it's a rather lengthy definition, but I think it captures the spirit of it. That it's about capital allocation, about risk management, and about financial processes that integrate sustainability considerations into those, traditional finance areas, right? Finance is about allocating capital and managing risk and developing securities and processes that help to do that. And, so I always think of sustainable finance to me is about integrating both environmental and social considerations into your decision-making process to promote both a more sustainable future for us, but also economic prosperity. And I don't think those 2 things are as mutually exclusive as some people once thought they are. I think with change, of course, some things don't benefit from change, but there also comes a lot of opportunity, right? And actually, it's interesting when Jon was mentioning earlier and getting involved in AI and finance and fintech, right? Like that was a major adjustment to the financial markets to have to recognize this is now part of our day-to-day business. And I think for the large part, people recognize that now, and it's been integrated into a lot of operations. So.
What are your thoughts?
So risk management is obviously integral in virtually every facet of finance and investment management. Sustainability, do you think that sort of just pushes out the definition of risk management to sort of encompass a broader range of different risks, or other dimensions to sustainability relative to finance that are not properly captured under risk management?
And I think that's part of it, and that's probably traditionally how sustainable finance started to become accepted. It was viewing it as if we don't do our due diligence, on environmental, social factors, and clearly governance factors is something that the mainstream financial markets addressed over a decade ago and realized, wow, we really need to pay attention to the quality of our boards of directors and the shareholders and other governance factors. And then it started, with the attention on all the, like, take the insurers. They can't ignore all the damage that climate change is already doing to their bottom line.
Mm-hmm.
And then when you start looking at pensions with 30, 40, 50-year tails, and they start looking at infrastructure investments, if they're not paying attention, it hits their radar right away. It's like not only mitigation of climate change, but adaptation factors are important too, right? So I think buildings and infrastructure are maybe an example that's easy, but it's kind of quite obvious to you. So I think it started to make its way in there, but then, and I think correctly, that recognizing that also with change comes opportunity. And I always think of risk as the flip side of opportunity, right? So, I mean, if there's risks to one company, that means it's opportunities for other companies. And if there's risk to one investment, there's opportunities. And the idea is not to restrict the universe, but to put a broader sustainability lens on the investing universe, right? And I think there's a lot of empirical evidence that shows, at least in the early returns, that those investors that focused on these things did better. And it's always hard to quantify some of those stories, but there's certainly not much evidence that they did worse, right? So, and if you just think of it logically, how can looking at more information, unless it overwhelms you, right? But if you look at more information and you do so strategically, how can that make your investment performance worse, right? It seems like it has to be a good thing, like I said, unless it just overwhelms you. So what you do is you devise strategies to deal with that new information.
I think, I guess for both of you, Dr. Cleary and John, for me, for me, it took me I have to admit, it took me quite a while to tackle the word sustainable. And get past the initial biases of what that word actually entails, like what it actually means. And I think initially I thought the word sustainable pertained to natural resources and the sustainability of reserves, whether it was fossil fuels or metals. It kind of encompasses that as well. And then the context of the word sustainable. I think, John, it's interesting that you wrote a book about the failure at Lehman, and if we're talking about the sustainability of financial markets, there were behaviors going on in financial markets that were unsustainable, and so you could say, was the previous regime of financing and leveraging and investment banks being involved in the way that investment banks were involved in markets, you could say that was unsustainable, and that came to an abrupt end because it was unsustainable. But that word has so much abstraction, and it can be used so specifically and then at the same time so ambiguously, that I almost feel like that's part of the problem. Is the solution, it's that universal word that can be used to describe all of these different situations, and at the same time it can also be the cause of biases that prevent people from taking a deeper dive and learning about sustainability and learning about ESG, because of those biases that get created by the ambiguity of the word itself. So I was wondering if you could comment on your thoughts on that, and if there's a better way to get through, for example, to advisors on the true meaning of sustainability, and what you see as the most frank definition of sustainability.
Well, it's an excellent point. You're right. There is no universal definition. We have the UN SDGs, or Sustainable Development Goals. There are 17 of them, right? Everything from no poverty to no hunger, to sustainable cities, responsible consumption, peace, justice, and strong institutions. Like, you should really look at what is driving some of these goals and the things that we're headed for. You're making a very sophisticated point about these kind of laudable goals that lead to some strange conditions and positions, ultimately leading to some, real crises points sometimes. I think it's useful to remember that the spark that started the global financial crisis really had to do with subprime mortgages.
Right.
And subprime mortgages were largely driven by government policy to solve other social issues, like too much incarceration, reduction in taxes, things like that. So there was a real government incentive to support putting people in homes that couldn't afford them, rather than not putting them in homes at all, to increase the tax base and to solve certain social situations. So, and then if you add on to the fact that the financing arm for purchasing that, like who ultimately owned those assets, really were semi-governmental organizations with the goal of, improving and increasing home ownership in the United States. That was the foundation that spread and metastasized through the global financial markets, along with some errors in terms of the ratings agencies, you know, mismarking certain assets as AAA, which in fact were quite risky. But that's
Yeah.
about financial innovation and trying to solve a specific problem through financial innovation. So I agree that there are these really important areas for people to think about in terms of investing. And the obvious example, the one that pensions, at least from where I sit, I can see they spend a lot of time thinking about stranded assets and worrying about some of these assets. And sometimes a lot of the talk of sustainability resolves to a question of, do you want to invest in fossil fuels or not? The University of Toronto Asset Management just categorically decided to exit from fossil fuels and divest completely. That will be a real question mark about whether that's a good financial decision or just a political decision in that regard. It has not been that's not the traditional industry response to any of these things, because you know uh, fossil fuels, the oil industry, and related industries to oil make up a huge proportion of the TSX and the S&P. And so you really can't afford to really restrict your portfolio by 30 or 35% of the entire market. So it takes some sophistication to think about it. And then you look at on the other side, you say, well, let's avoid these risks. Let's avoid these problems that are foreseeable in terms of climate change and government regulation and taxation that are going to come. On the other side, there are these great opportunities, which might be in EV or other certain technologies associated with that. So I think it's starting to think along those lines, but we're in the early days of this. I think it's very important to be aware that the bedrock of finance, of making decisions that are creative and what's an NPV project, is getting harder and harder to think about, because we have to take on both of these kind of hard empirical science aspects, like climate change and how much carbon goes in the atmosphere on one hand, and then on the other hand, you have to think about social issues and these other areas where there isn't a good answer to the question of what's ESG when you combine something that is kind of categorically different on both sides. And it explains why ESG ratings are all over the place, and that it's not easy. It also explains why that the bulk of ESG investing has been focused on equities, because there's so much data in terms of what's available for equities. Now, so that leads to a strange position of, yes, there's this big focus on equities, but the ESG opportunity, in fact, could be much larger in certain other areas, which would be maybe some of the alternatives and other things. When we're really thinking about how do we apply these sustainability goals, and what are the investment areas that we really need to think about, I think that the alternative space is a really attractive, interesting space for doing just that. Because ultimately, if you're a small investor on a gigantic company and you want to make some sort of ESG improvement, almost impossible. But if you're you're involved in more of an activist strategy, then you really maybe have the opportunity to turn the dial on certain investments in an important way, then to help them think about what improvements in ESG really mean. Because really, one of the underpinning challenges is, do we just say, I only invest in companies like Apple or Tesla or something like that? Or do I try and invest in companies that maybe aren't doing well, but that can turn the dial and improve their position significantly through innovation and paying attention to some of these sustainability goals? Like one of the most fascinating areas is just boring old concrete, and some new technologies associated with that, with like carbon, carbon injection and certain developments from the technological perspective really may hold a lot of value for the future, because just some of these industries like steel, oil and gas, and
Yeah.
concrete are really very, very large emitters, and those are things we can do something about. So I see a great opportunity in some of those spaces, and yet maybe the places where people have focused historically, I think a lot of them are tapped out to some extent, and the valuations maybe reflect a lot of high expectations in terms of ESG.
Yeah.
I think the ESG movement is motivated by a desire to leave sustainability to the greatest extent possible to free market forces. I think one of the challenges that we have in financial markets, and we've chatted about this, Jon, and other forums, but is that there's perhaps a misalignment of time horizons where investors and managers and most stakeholders in the investment process are incentivized on a horizon on the order of sort of 1 year, maybe 5 years, and on the very outside, maybe 10 years or a little longer in the case of certain institutions. But the externalities that arise from investment in many long-term global projects are expected to pay off on the order of decades and in some cases centuries. And so, I know that ESG is motivated by a desire to leave as much of this as possible to free markets, but to what extent can we leave this to free markets versus combining free markets with regulatory policy as well? And then just speaking to ISF, what role does ISF play in guiding both investment principles and then also helping to inform regulatory policy around the world?
Yeah, well, we that's a tough question, but we clearly we do objective, relevant research and provide education. We don't actually control capital ourselves, so but we definitely are involved in the conversations and contribute to those conversations in terms of research that's important. Education is huge too, because we need to train the next generation and a lot of the existing generation how to answer these questions that are coming up. And and if they can't answer them, if you can't answer them, they'll go across the street to someone who can answer them. Like I think there was a survey by RIA Canada, Responsible Investment Association Canada, in 2020, and said that 75% of retail investors wanted to know more about ESG, and only 26% of them had that conversation with their retail advisor. So, quite frankly, either the advisors are assuming incorrectly those types of things aren't important to them, or they're just not comfortable enough having those conversations. So I think that tells you that the future is now, and we can't keep waiting, because the next generation is going to be even more focused on these, and time is running out. But back to part of your question about policy clarity, it's a transition that the private sector is leading in some regards. You see the pensions demanding better disclosures, and TCFD, to Task Force for Climate-Related Financial Disclosures, and SASB, which is Sustainable Accounting Standards Boards. All 8 pensions signed that statement in November, and then gave 10 largest similar statement to the SEC in the U.S. And you don't see them banging together that often for things. So there is a lot of pressure, but as you're alluding to, it's hard to start devoting our capital towards longer term solutions like transition minerals could be an opportunity for Canada, right? And until in clean tech and the carbon capture and storage and hydrogen, but until there's a little bit more policy clarity, make no bones about it. Most of the capital has to come from the private sector, but the public sector, and think of infrastructure I mentioned before. A lot of the infrastructure decisions are dictated through policy. So the private sector can drive only so far, right? So there needs to be, and we just finished a report on the update of that Canadian expert panel report, and that was one of the key messages to come out. There needs to be more communication between the public sector and the private sector, because this is a key strategic transformation. It's not going to happen overnight, but it's already in progress, and we need to do it properly, and we need everyone to know what's going on, right? That's how you unlock the private capital, right? When people have a vision of what it's going to look like in 2 or 3 or 5 years. Great point.
Yeah, I wanted to just
Yeah, go ahead, Pierre. Sorry.
go back a few steps, because I just to talk about the unintended consequences a little bit of policy making, and John, you mentioned that the financial crisis in 08 was set off, of course, by subprime, and that subprime, the birth of subprime was an ESG initiative in disguise, right? I mean, it was meant to sort of reform social justice, criminal justice, provide some social reform in terms of home ownership, and they kind of backfired, right? I mean, I think that when we get a lot of mixed commentary from advisors in our audience, some of it is angry, right? Some of it is this anger about how policy making is threatening to hollow out the energy sector, for one, and so we end up looking at unintended consequences quite a bit, and so when you look at other unintended consequences potentially of ESG, one of those is the inflationary pressure that it is signaling to put on metals, for example, on the metals market, and on right now on natural gas, and that inflation in general is going to victimize the most vulnerable quintile of the population, because the cost of energy, for one, becomes untenable, and then of course there's the corollary argument that the cure for high prices is high prices, but so there's a lot of you can tell something's definitely moving forward, because there's a lot of controversial views on it. On one side, a lot of anger and sort of dismay about what ESG actually means, and then on the other side, you've got the ambivalent, who don't care either way, don't think much of ESG, or they just think it's a marketing ploy, and so how do you overcome that problem of the unintended consequences? Another sort of unintended consequence, I don't know if I brought it up in another conversation, which was the movie Anthropocene, where the coal mining in Germany is highlighted, and that they're literally tearing up Germany to get lignite to power their electrical utilities, and this is because 10 years ago or thereabouts, the Fukushima event happened, and German politicians decided that they were going to mothball half of their nuclear plants. And so now, literally, they're not only are they tearing up the rural countryside of Germany, but they're starting to encroach on towns and villages and eating up the land underneath the towns and villages. And so there's this scene Anthropocene, where these harvesters or these lignite harvesters are digging out, acres and acres of land each day and destroying the German countryside because there's no power. Now Germany has some of the highest emissions problems as a result of making the decision to mothball nuclear. And then they're running up against shortages, so they're buying electricity from France,
Right.
which is nuclear, which sort of defeats the whole purpose in the first place of having mothballed nuclear, except that it displaces the nuclear problem, in France. But so you've got all these policy making decisions that have an equal and opposite reaction. Just like the law of thermodynamics, you have this equal and opposite reaction that's happening with every substantial policy decision. And maybe I feel like maybe the focus of ESG should become technology, a technology focus, as opposed to let's cure all these social problems and let's cure these environmental issues and let's fix governance. You almost want to. I almost feel sometimes like if you have this political spearheading of the ESG term, and the intentions are wonderful, right? But sometimes the road to the road to hell is paved with good intentions, right? And so I wonder, what your thoughts, how either of you handles those sort of controversial feedback, those items of controversial feedback from the pushback.
Like there are several things to unpack there, and it's probably the hardest question I've ever been asked, I think.
Yeah.
But let me put it this way: are you right about technology? Without question, you're right. And it's a little bit more on the line here. I think that there is a reality of global warming, and there's a real problem with the oceans and the implications of that. If we start to see a dead or deadening ocean with increasing temperatures such that oxygenation just doesn't really work anymore, and you have large portions of the ocean that are in fact dead, that is foreseeable if we keep on the current path. There are, as an example, there are plastic islands. One is floating around the Pacific that is the size of Texas. Now there are 7 of them globally. There's a massive real problem with the environment, without question. It's a massive problem.
The gyre.
You are in fact entirely correct when you point out that some of our solutions to this will lead to further challenges in that regard. We want to build these, turbines, the wind turbines and all, and we want infrastructure spending. I mean, we had a $1 trillion infrastructure bill in the United States just passed today. The S&P was up 0.02%. I mean, it's entirely, it seems, priced into the market where there's no bump for a gigantic piece of spending. So you are absolutely right that I think technology is really a key portion of it. I think I still think we need to get our heads around all these different goals and going in different directions. That in its worst form, that ESG can be seen as kind of a form of greenscaping or just good marketing to get to people. I mean, certain regulators have taken that problem really seriously, in the SEC and Europe. The European regulators have come down hard on managers that are pretending to be sustainable but really actually aren't doing that. So I think that has to be driven, like you've got to get the bad actors off the field to some extent. But to your point, I think we're going to have to hone down all these diverse, things that would be great to do, but maybe won't turn the dial, or maybe pointing in a different direction than we would hope. And so some of these goals, like net zero by 2050 and others, and that's a very specific one. We're either there or we're not going to be there. And it's probably not going to be sufficient for companies to go out and buy carbon credits to kind of cross the line. I think that people are going to be looking very closely. There are lots of companies today that consider themselves net zero, not because they aren't large emitters, but because they can afford to buy those carbon credits. So there's a certain
Yeah.
amount of arbitrage going on internationally, and we do have a really complicated system. And look, it's more intractable when you think about the nature of those emissions. If you just focus on the carbon emissions and the relative size that that China plays in that versus the United States or Europe, really, really fundamentally challenging to deal with a developing emerging market. Uh, and trying to get them to pull back on all the heavy industries, which in fact have been, they've been relocated to China because they were able to operate efficiently, because they didn't have the same sort of environmental protections and regulations associated with that. So now we want to say, by the way, shut those down now that you built those plants. That's going to be a really tough political call. But to the solution to any international problem, and you're right,
Mhm.
like it's kind of like nuclear weapons, right? Like it doesn't matter that where the nuclear weapons are. The United States can say no more nuclear weapons on our shores, but everything, outside of Bermuda is fine for nuclear weapons. That doesn't solve your problem. You have to get together and agree on the rules of the road. So closing off some of those externalities, those free lunches that people are having, where like dumping into the oceans and, you know, looking for, the international arbitrage situation of which country can we go to such that they won't care that we're dumping these toxic chemicals into the ocean. Those are things that we have to come together and agree on some of those. And the only way to get something good out of that, I think, is by doing kind of what COP 26 is trying to do, which is establish rules of the road. And because we've had kind of a certain lack of leadership from the traditional sources in some ways, it's been more uncertain than ever that Europe and the United States and other locations develop their own rules in some ways, or have them in transition as we speak. And then the question will be what, I take Professor Cleary's point makes a lot of sense in the normal course. It should make sense to invest in clean companies that don't destroy the earth, that don't do horrible things to people, that don't, toy companies that don't use lead paint are better than toy companies that do. That should
Yeah.
be simple for us to get to. But as we start to really see the overall performance, like I think we're in too early in this in some ways. That some of these issues that we're going to have to address are going to require investment. And the two big areas that you're going to have to think about for investment are how are we going to invest in these technologies to get them to the next stage? Because venture capital is not going to get us there. That is the wrong model. They're going to be flippers. They're going to get
Right.
you up, turn you into a unicorn, and then they want out. That's good for your market share. That's good for your returns, but that is horrible in terms of building big kind of infrastructure like technologies that are going to be transformative on the world, to give them the time and the research that is needed to kind of to get them to that next level, such that you can develop some of these great new technologies that are going to really help and help not just in an economic sense, but also in solving the problem sense of hitting our emissions targets, and also looking at the temperature issues in particular. Like it's really great that we've set these targets, but we don't know whether those targets are in fact going to be exactly right, and we don't know what the impact will be or what the unintended consequences of some of our behaviors in fact will be. That those are the things that I think we're going to have to think of as a really important part of this, because this is it's pretty clear that if we listen to um, the kind of the big thinkers in this area, and then like David Attenborough is looking at the destruction of the natural world. We're in the midst of certain profound extinction events. And we may need to change our targets to address that. It may be that we write down that it's a 2% target or 1.5% or whatever it is. But in fact, if that is really devastating for the world and not a world that we want to live in, then we're going to have to adjust that. And so I think that people need to be ready for continued change in this area, which is what I think from an investment perspective means that you're going to have to be on top of this on a continuing basis and watch out for the big risks, as well as watching for some of those big opportunities, because I know that EV was a big one, and that's been one in the past. There are more coming through. They may not sound that sexy, but they're fantastically interesting when they have broad, scale and scope for some of the new technologies that are coming out, because some of them are definitely developing and coming forward.
So let's go there, because I think a large segment of listeners are here for the investment implications. Yep. And Sean, you mentioned some specific examples of what might be near-term or intermediate-term opportunities for investment, where investors may be able to generate outsized returns, and also that are in the direction of sustainability and long-term thinking. If I recall, one of the sectors or segments that you mentioned was transition metals. Did I get that right? Or transition minerals? Do you want to start there and maybe provide a few other examples of interesting potential areas of investment?
Yeah, and I would qualify that these are pretty early on, but if we look at the development of the EV car market, right, then we're going to need the minerals, the metals that go into producing those batteries. And we are, jumping on. China's well ahead of us already in that regard. I wrote, on the flip side, they're still building coal mines there, so we're ahead of them in that at least. But they've taken a very concentrated effort, and you now see announcements by Biden and by Canada that this is coming forward. So I think, with Canada, and here's something, this provides ESG. This is an example of ESG factors providing us an opportunity, because we can produce some of those minerals cleaner than others, and certainly with less of the social issues that go on at others. And hopefully the governance of some of our companies score well on that regard too. So I think that's like an interesting example of, taking the opportunity out of this. And I think it's well recognized. I would say there's still early stage opportunities, but if we develop the market correctly, and this is where, back to the previous conversations, it's about doing things correctly too, right? Like if we don't develop it correctly, maybe we miss out on that opportunity or part of that opportunity, right? So, and that's why we need to have the regulators in the private sector and the suppliers of capital all having their voice heard, right? And I think those are important considerations we need to really open the lines of communication better, so that everyone hears what the other parties are saying is important to them.
Yeah, John, thanks, John. Do you have, John, any other ideas to add to the investment opportunity?
I think that's right. I think traditional investments in terms of equities, for active management, there's a real opportunity there. If you're just looking for access, there are lots of quality ESG ETFs to think about, and let someone else who's focused on that think about what ESG means, and just allocate that way. Can be a relatively easy way for advisors to think about getting access to this. There's everything from, when I think about ESG, I don't think about it as like you would immediately know whether a business was ESG or not just by saying it's EV. You could have really horrible businesses that are electric vehicle businesses, because they're so destructive, that they use horrible labor practices, they do other things like that. I think what's really important is to think about, to understand that each area that we might want to invest in so there'll probably be more emphasis on biofuels, renewables. There's going to be more focus on water resources like that. Healthcare is going to be important. Um, Everything from, oil and gas. I know that people think that that's like the antithesis, but we could have a really big change in some of those oil and gas companies that really could turn the dial in some important ways. And if anyone can do that, I think it's those areas, um, because they have the capital and they have the determination and they feel the hit more than anyone else. And then everything from looking at fintech or new developments in certain areas, I think are really important for us to think about new sustainable apparel companies and other things like that. New companies that are looking at packaging, very interesting. Sustainable packaging is a huge problem. Just the proliferation of plastics and the need for certain alternatives. It's not easy right now, but if you can get in on some of those opportunities, that's massive, right? That is a biodegradable plastic. They exist. They just aren't developed in the same way. So I think that there are lots and lots of investment areas to really think about and to focus on in the traditional markets. But I would say that the thing that I would expect more than anything is that I would expect more inflation in some of these sectors that are considered hot from an ESG perspective, and that we are seeing significant inflation and significant money printing associated with that, as we've talked about. That if it, the even though the S&P is up pretty much 100% year over year since the beginning of the pandemic, uh, money printing is up more than 400% in terms of just the United States alone in terms of M1. So you have a massive amount of capital that's come forward. We know that inflation for the past 4 or 5 months has been at least 5%, and we know that the risk-free rate is much closer to zero, or in many locations it is in fact negative. So on a real return basis, what I think that advisors should be focused on is looking for inflation-adjusted investments that are kind of suited to the new economy, that are reflective of kind of some of the ESG factors. And to that point, I think that some of the technology areas clearly are doing better than others that have seen that uptick. The traditional areas for inflation hedging, gold has been a disappointment in that regard. But then again, other metals, there's been significant uptick there. And then also like think about the new areas and areas of technology to think about when we're thinking about that. Like, it's something to look at, crypto investments, crypto assets, and really alternative investments, because when we're dealing with a difficult situation, a difficult changing rules, that's a really great opportunity for investment managers to recognize that when you have an inefficient allocation of capital, because they can make investments that capitalize on that. So I would be looking very carefully at certain types of venture capital, private equity, private debt, infrastructure investments for sure, and thinking more broadly about their investment horizon, because we tend to put people into really liquid investments, but there's a liquidity premium, an illiquidity premium that can be gained from thinking more long term and not in the traditional locations. So I think that, you should be really looking at, fixed income alternatives in today's market that can beat inflation are a very attractive option. And they exist, but they may not be the same as or as easy as kind of investing in your traditional AAA bonds or things like that.
Yeah, there's an interesting path dependency to the transition, right? And we're seeing some of the effects of that right now in the fact that you've got, for example, University of Toronto, and you've seen similar announcements from major pensions in the United States and other institutions in Canada and in other jurisdictions where they're divesting of companies and industries that do not serve the sustainable agenda in the long term. But the consequence of that, of course, in the short term, is that there is a dearth of capital for the investment in expanding production of, for example, petrochemical-based energy resources, and then also how to think about expanding the capacity for the production of other transition metals. I'm thinking about this report from the International Energy Agency that came out recently, which highlights that electric vehicles are made with 6 times more minerals than internal combustion engine-based vehicles. For example, the battery for one Tesla Model 3 contains 56 kilograms of nickel, 7 kilograms of cobalt, almost 7 kilograms of manganese, and 85 kilograms of copper. And what this means is you need a 40-fold increase in the production of lithium and nickel, and 20 times as much copper, graphite, cobalt, etc., than we were able to physically mine in 2020, right? So there's this interesting transitionary period where I know we need to look to the future and ensure that we're investing in tech and regulation and policy that provides for a sustainable future, but then also providing a path to allow us to transition without eliminating the input to production that currently serves the global economy. So, from the ISF perspective, or from the perspective of ESG advocates in general, how do you view the sort of path dependence or asynchronous nature of when these technologies the sustainable tech is able to take over, versus needing to invest in legacy facets of production in order to sustain growth in the interim?
Yeah, I'm glad you asked me that, Adam, because I'm getting the impression here that when we're talking about ESG integration and investment, that we're not talking about the same thing. Because in my perspective, it is mainstream looking at all of your investments, not just looking for, transition minerals or wind, renewable energy, and then getting rid of anything that's not, hitting this trend. Clearly, we need financing for those things, but integrating ESG considerations is not just about that, and it's not just about divesting. In fact, most investors don't divest, or maybe they do it quietly, but they do engage a lot, right? And that's the thing about the investors that stay in those industries, is then they have an impact on a lot of, they do. It's an opportunity for active management. I think Jon mentioned it before, right? And I think there was a survey, RBC does this survey of institutional investors every year. And last year, 2/3 of those surveyed said they used ESG integration because they thought they could generate alpha. And you've all been in the business for a while. You can generate alpha the best if there's something that everyone else isn't paying as much attention to, right? Or there's not widespread information, that's why small stocks for a while, and so on and so forth. And that's why we had quant strategies evolved, right? And then as soon as everyone got the same information and recognized that, they started, those arbitrage opportunities disappear. And I'd say we're getting close to that point, because although there's an information lag, which is why investors and those big pensions and the BlackRocks and everybody's demanding better information. But as long as there's a bit of an information void, that creates an opportunity. It also creates a risk, right? Because you're holding securities and assets in your portfolio, and if you don't have the full picture on them, then it creates, a risk. Whereas if you can assemble that full picture, it creates an opportunity. So I think, for generating alpha, it's probably one of the best areas out there today. For the very reason that it's very frustrating to those involved in it, this lack of good information. But we're seeing pressures, like we saw an announcement from the CSA a week or two ago about movement to integrate TCFD reporting, right? And those types of things, that's coming on the heels of the institutional investors and the general public for better information. And the funny thing about that is that will be beneficial to the companies, even though it will be a bit of a hassle. Well, it will be a hassle for them the first time, but understanding where they are, where their carbon footprint is, where their strengths are in their governance structure and their social issues, those are things you want to know ahead of time, right? Because the funny thing too, and I was going to mention COVID earlier, having these conversations, everyone said once COVID hit, that was going to be, nobody was going to be paying attention to ESG factors at all anymore, right? And in fact, it was just the opposite, because they said, wow, a big systemic risk that everyone knew was a possibility since SARS that we didn't adequately prepare for hits us and nails us. What does that sound like, right? It's like climate change, and we're getting we're getting monthly reminders of the effects of climate change, right? With flooding, and I used to love to go to Toronto Island. 2 of the last 5 summers, you couldn't get over there, right? And it's just getting warmer. So these are not, you know what I mean? These types of what we call isolated events and wildfires are unlikely to get less frequent since we're continue to get warmer, even if we get to 1.5 degrees or 2 degrees. So the world is changing, whether we like it or not. And I think the pragmatic thing to do is to start thinking about that and planning for it. And that.
He'll be back. You know, it's funny because there's some game theoretic challenges, and we're seeing some of this play out where you have this underreaction, overreaction effect. So, for example, at the moment, you've got the COP26 meetings happening, the symposium, and they happen to be taking place at a time of skyrocketing energy prices globally. You've got a massive natural gas crisis in Europe. You've got China shutting down the electrical grid or phasing in and out different regional electrical grids, which is impacting the production of a variety of goods. At the same time as the COP26 meetings are happening, and you can see some of the effects of the timing in the policy response that's coming out of the symposium, where, sadly, I think from one perspective, sadly, they're walking back a lot of the policies on reduction on the reliance of coal, or reduction on the reliance of carbon-based energy sources, because they're recognizing the impracticability of instituting these anti-carbon-based fuel policies too aggressively before we have effective, scalable substitution, right? So, we have this very zealous policy stance. At the last symposium, it guided global companies, in the petrochemical industries to reduce investment. And we see these in the CapEx numbers over the past decade, where year in, year out, global coal and oil and gas exploration production companies each year have invested less and less and less in CapEx. And now that's resulting in, for that reason and a variety of other reasons, in a massive spike in energy prices at exactly the wrong time for the current symposium to try and set policy guidelines going forward, right? So it's really hard to account for all of these potential interaction effects and path dependencies. So I think we need to take a very nuanced and tempered approach to how we think about this. And then again, the University of Toronto and some other organizations taking, and I think, Sean, you spoke to this, right? The opportunity here is not divestment, but rather guiding investment in the necessary sectors of the economy in order to perpetuate global growth and meet its shorter and intermediate term objectives, while also guiding industry onto a path of sustainability, right? Do you have, what are your thoughts on how to best thread that needle from the conversations you guys are having?
Well, on that issue of divestment, I mean, look, I agree with Sean that there is no good or bad ESG company. There are factors we have to take into account, and we're going to have to pay attention to now more than ever. And when you look at kind of a nuanced risk management approach that incorporates ESG, it's not to say that every single thing matters. There's lots of investments where the key consideration is not greenhouse gas emissions. It could be something else. It may be human rights. It may be your product design, life cycle, things like that. There are, I would encourage people to get familiar with that, because ESG is really just about, and sustainability is just about integrating that into your investment decisions to avoid kind of obvious risks and to look for these good opportunities for the future. And that's really about, capital allocation is about just that. We're not changing the nature of the game at all. We're just adding a more nuanced approach to recognize that, hey, the world is changing, governments are changing. You have these big international governments coming together to think about these things, to set standards. And we need to be aware that the next thing that comes after they get you to agree to do this, and they're getting many of the big investors to agree to do just that, to follow the UN principles of responsible investing or other kind of benchmarks to some extent. The next step is regulation and taxation for people who don't. They want to encourage people to aim in the direction that they want to go to. But to your point, is it obvious immediately? There are going to be real challenges going forward. I personally am not a fan of divestment. I think that is a terrible idea, that these are important areas to invest in. People still drive cars. They still need to heat their homes. They still need all the ancillary products that are associated with this, the plastics that make medical devices, or all sorts of different products. I think that you can't just kind of walk away and make this a political decision. That to me is not investing. And when people do make political decisions, then I think that whenever people are making non-economic decisions purely for political end, then that's maybe a short-term trading opportunity. So when you see that happening, and you see a lot of people walking away from a certain industry that they consider to be dirty or bad in some regard, and could put that in quotes, that's probably an area that you'd want to pay attention to. So as a contrarian, you might want to go with the flow in certain regards and say, yeah, clean companies that do good things, that follow ESG criteria, yeah, that's a good company in general. But if there are these kind of unloved gems for whatever reason, then that can also be, as from a contrarian perspective, you can take that perspective and invest for that. Now, that will require, as you pointed out, Adam, a different liquidity profile in terms of investments, and you're going to have to suffer through certain period of time when it may take a certain amount of time for people in Germany to recognize that there are these horrible consequences associated with their kind of categorical decision, like, Fukushima, horrible disaster, horrible, entirely man-made disaster, by the way, and probably isn't even over. But to then take it to the extreme that you want to now say, no, nuclear is not viable at all, and we need to move away from this. Yeah, that's probably the wrong lesson to take from it. More like improve your safety and security associated with some of these important energy decisions in these important industries. But to some extent, you can feel that the baby may be thrown out with the bathwater on some of these. As an investor, I think that's usually, that can be a bad thing initially for investors, but it's often the case that we recognize that there's a baby and that we have to take steps to address that. But to the larger point of, is the environment changing from a finance perspective? Without question. What people are allocating to is changing, and the cost of capital. Clearly, people are trying to provide incentives to give certain projects life. And then, and with that, maybe the learning lesson is, with this whole sustainability area, you probably do need to rethink your investment horizon, the liquidity that you need for your investments, and try drawing out and extending it to over a longer period of time, so that you could look at rare earth metals or some of the other semi-precious metals that are important from a certain perspective, and not necessarily look at it day by day, but take a strategic viewpoint to recognize that there are these imbalances, and that it may be that these are are unloved right now, or that in the future there's this huge opportunity that just hasn't been recognized yet. Rare earth metals, they aren't making more of them. They take an incredibly long time to develop a working functional mine, and that these are the types of things that will be truly, vastly more valuable for the future when we're trying to address these, the needs of EV, and also the ancillary products. Where remember that this is a technological revolution that is happening at the same time as an ESG revolution. Can't The underpinning of a lot of this is that we have these new technologies that are really transformative. And they're transformative in the sense of they're displacing old industries, old jobs, the way we do things in a fundamental perspective. And now, we have robots that are doing many of the jobs that humans were doing before. And those robots are also working on are beneficial from a sustainability perspective. So there's always this balance that we're going to need to tease out, because if we just thought about answering the question of should we have fewer cars on the road, from a certain perspective you'd probably say yes. But then you said, well, but what about the consequences of that? What about the consequences to the economy and to jobs and people, where you have the United States alone, said before, 20 million people, their direct job is driving. Now you maybe have the technology to be able to implement this, but are we ready for the knock-on effect of that from a social perspective? And then you think on top of that, you're working in we have to then we realize, oh, but we have to agree on all this, and we have to get these policies through. And we work in a democratic system for the most part in the Western economies, such that
with a 4-year
right, you have a
term.
4-year term. Thinking long term is pretty difficult when you're doing that. And then look at the reality. Largest infrastructure bill ever passed since FDR, and the S&P is effectively flat for the day.
Mm-hmm.
Now that's breathtaking. Not for what happened, but for what didn't happen. It's really remarkable. And then with all of the big challenges that are looming, I think that sustainability is super important to focus on. I don't think that there are easy answers, but I truly believe that active management, if there's any area that you want to focus on to get active management, I mean, the implementation of ESG factors is one of the areas that it is so important, because people need to be watching this very carefully on a regular basis. And it's not just because someone did well, last year on their ESG, it actually could be changing this year on an ongoing basis. And those are the things that people are watching for carefully.
Yep. John, I would tend to agree with you on, in terms of ESG investing, that this is it's the active side that's really going to be able to find and unearth, the opportunities, as opposed to the passive side. Seems to me on the passive side, there's a lot of shareholder engagement from the likes of Larry Fink, for example, but it's very generalized, and it's it amounts to a very generalized call for ESG reform, and then that's where you get, because of sort of an attempt at standardizing ESG, you end up with the greenscaping or greenwashing that's happening, so sort of systemically where it's happening. It's not widespread, but it seems to be that it's fairly easy to jump on the green bandwagon or the ESG bandwagon just by meeting the minimum requirements, adding diversity to your board, or starting initiatives to clean the environment around your properties, and or around your production, and or any other sort of social or environmental or governance reform. But on the active side, I found, in conversations with portfolio managers who are active ESG managers, um, that there was far more interesting conversations happening at the active level on the bottom up side. So where you have passive, where, passive is more of a top down approach to ESG. On the active side, really you have a bottom up, more bottom up, stock by stock or company by company mentality. And one of the interesting, I think one of the interesting stories to come out of conversation was, with regards to a mining company who had, and I can't name the mining company, but it was surrounding the issue of some of their indigenous staff and, needing to go on their annual hunt.
Mhm.
Right. And so this one particular mining company said, okay, go on your hunt, and when you're done, come back and resume. Right. And that singular sort of uh, you know, not permission, but that company opting to give their employees, their indigenous staff employees, that flexibility to leave without facing the threat of unemployment made a huge difference in their turnover, in the turnover of their retention as well, is what I'm getting at. But that same active manager could then go to other mining companies in their portfolio and say, hey, so and so is doing this, and it had a massive impact on their retention, their turnover of their staff. They let their indigenous employees go on their annual hunt and come back when they were done, and their indigenous employees are far more happy. They're far more likely to be loyal to the company, far more likely to enjoy their jobs more because they don't feel like they're being blocked from doing things that are very important to them culturally. So that sort of active management uh, feedback mechanism was incredibly, at least in my estimation, it was incredibly valuable. That an active portfolio manager could have that conversation with one company and then carry that over to the next or to the others, and share that same feedback. And likewise, I mean, it could be something company B is doing. It goes back to company A and say, why don't you try this? And so those little individual, tips and sharing of policy decisions at the company level, as opposed to at the, political level, uh, would have more impact than sweeping changes. Sweeping policy changes might have unintended consequences, but company by company, you might have more impact if you were sharing knowledge across a portfolio.
Yeah. And it goes to this idea
Right.
of stewardship and engagement.
Yeah.
We are stewards of capital, and you want, our investee companies to do the right thing. There are ways to do that. And there are ways to engage and to talk to them about specific issues. But as you say, it's not always air quality or energy management. It could be labor practices or human rights or
Yeah.
health and safety that are really meaningful to a particular company. And all of those dimensions are ESG considerations. So, yeah, to your point, they're by the concern that I would have about categorical approaches to things like that, saying, I divest, I'm out, is to really, is to make a political decision when what you really want to see is a more sophisticated approach to making things better and helping get there and monitoring for these issues. Yeah, so you know what? If you invest in a toy company, you may think, what does that have to do with ESG? But if it, again, if it covers those toys with lead paint, you got a big problem. And that is an ESG problem, that the health and safety of your customers is really important. And so that's why taking on some of these larger issues, whether this is the task force on for reporting, or for SASB or others, some of these multinational organizations that are impacting things, they're not asking you to divest. They're asking you to be thoughtful and about your investments and to add something new to it to consider these sustainability factors. And when you really look at what they're asking you, what they consider to be material risks in different sectors, I think people will change their mind about what sustainability is and really think that, you know what, living in a world where we do take these things into consideration is better. Companies that don't categorically just tell people to get lost and have labor unrest and strikes and things like that, versus accommodating people to, go on their annual hunt. By the way, General Motors does that with, deer season, and that was the negotiated term of their collective agreement. Just making those kind of those easy wins, I think, is important. And to your point, technology and investing in technology for the future, thinking about active management in a more sophisticated way, and just and taking a longer viewpoint are things. These are the really key considerations to just really understanding what ESG means and why it's important for us to go forward with this, because these mandates are not going away. There's really good statistics on how important it is to certain investors that we consider these things for the future. And
Yeah.
the wonderful part for many advisors to think about is people are making non-economic decisions in this way. So in some respects, they're not going to be as focused on performance in the same way as they would be if it was just a purely financial model that you're running. That people want a better world, and if they feel like they're making investments that are encouraging that, or with investing with sophisticated managers who are encouraging the right decisions to be made, then they will be more receptive to those returns that do reflect that, rather than the purest question of who's the highest performer in my sector, and maximizing financial returns at all costs. So
Yeah. To your,
Um,
sorry, go ahead, Adam.
no. If you wanted to respond directly, go ahead.
I just wanted to go back to something John had said earlier, which was, you mentioned, for example, I love one of the areas that I personally love about some of the sort of more selective ESG opportunities are in the areas of new innovations. And you mentioned cement, where cement companies are sequestering carbon dioxide, which is captured in the cement, and it actually produces a technologically better cement, more resilient cement. But there's, that's one sort of alchemy that's really interesting, where you're taking carbon dioxide and turning it into an element by combining it with other carbon atoms to make cement stronger, and you can actually permanently sequester carbon dioxide in the cement. And then you have other companies like Carbon Engineering, for example, where they have these gigantic fans and they're sucking the carbon dioxide out of the atmosphere in the maybe in the middle of the desert, and they're turning that into fuel, right? They're turning that into biofuels by again combining it with other carbon atoms and then liquefying it, or making solid fuel. And there's other technologies, similar ones where carbon dioxide is, when I think the problem is that while those opportunities are can be exciting to contemplate, they're not getting the kind of capital that they should have. Um, you know, one complaint I heard was that these companies were coming up at a time when the marijuana phase was in a boom, where all the capital was going to marijuana companies, to weed, right? And so it was impossible to raise money for ESG companies while that was happening, while all the capital was being sucked away by weed, and so you have competing interests too, right? So these companies can be very exciting opportunities to contemplate, that a company can build a fan array that collects carbon dioxide and turns it into gas, or diesel, or some other biofuel, and or captures carbon and turns it into algae. Those types of situations should be getting more attention, but they're actually competing with the whatever's the fad of the day, or they're competing with technology stocks, they're competing with Bitcoin, they're competing with so many other more sort of manifest opportunities that are writ large in the market and sort of writ large on things like Reddit, and they're not able to raise those incremental amounts of capital, and that's where I think ISF, Dr. Cleary, comes in very comes at a very interesting time in the evolution of ESG, and that's that there needs to be definitely more education, more focus on the capital market, learning about how to find and identify these opportunities or how to value these opportunities so that they can properly finance them. And not be led away by the nose by whatever's hot that day or hot that year. Otherwise, the ESG sector, which solves very long-term problems, is going to have a very hard time competing with companies that solve immediate problems or solve for immediate, immediacy in terms of the immediate opportunity that they provide to investors. So it's very seldom that investors can look 10, 15, 20 years out and say, yeah, this is where I want to go because of the impact it's going to have 20 years from now. But it's much easier to say, well, if I buy Tesla, it could become, double what it is now for whatever reason. Or if I buy Bitcoin,
Not advice.
right? Right? How does the ESG marketplace compete effectively against whatever the short-term fad is for capital?
Well, I mean, there are structural challenges with getting certain investments. Like
Yeah.
there are certain types of what if you move over from kind of financial only to responsible investments to sustainable investments where you're considering both risks and opportunities, and then you start to go into impact investments and thinking about giving up certain financial returns on. And then you even go further than that. You end up in charity and types of areas like that. But there can be kind of where you're focusing on impact investments where there are certain technologies that aren't going to be economically viable in the same way or competitive with other certain forms of investments. But in a way, we have to maybe think about what would make that viable, and do we believe that ultimately there are going to be certain there'll be certain government support or tax breaks for some of these companies that do solve specific problems like that transform that kind of business to make it more viable. There's nothing there's no easy solution to short-term thinking and short-term profitability versus kind of a longer term view on something that doesn't appear to be that sexy or in the market. But in fact, if we think long term, it may be that some of these things that are hyped and then drop in value. And I think cannabis is one of those examples that, look, there's been an incredible growth particularly in Canada in terms of the development of of the cannabis market, and now we have consumption of alcohol and cannabis and other certain recreational kind of things like that, so that amount, according to StatsCan, is now greater than the amount that people people spend on their personal health care. Like, that's amazing when you think about it, that they've actually jumped ahead in the middle of a pandemic. Like, personal health care isn't that important when we're dealing with this massive health issue. So, I don't know that there's an easy solution to the question of should we be investing in just what's hot, or being is there a lot of FOMO going on? Probably. Ultimately, in the long term, if you can really solve some of these big challenges in an economic way, and that makes sense, with or without government support, because definitely a couple of things for sure are coming. Taxes on emitters and certain companies are going to be increased. Tariffs and things like that are coming in. And then benefits for some of these other companies that are going to be supportive, which will greatly improve their profitability picture, are also likely to come forward. Governments have shown one thing during the pandemic for sure, and that is they have no problem printing more money to allocate to prop up certain businesses. And as this goes forward, I think we'll see that the direction of that tilts heavily towards ESG, so that you have a secular trend away from the past where, that if we looked at the top companies in 2001 or even 2008, and you'd likely see lots and lots of the oil producing companies at the top of that list. And now that's not so. That we have dramatically changed in terms of valuation in the market, and that trend is likely to continue for those reasons. Because, yeah, please.
So I'm respectful. Sorry, no, I'm respectful. I'm trying to be respectful to Dr. Cleary's time, and we're at an hour 40 minutes here with lots of productive coverage of the topic. But I want to suggest that maybe we put a pin in it here and save something for discussion at our next meeting of the minds on this topic.
Thank you very much,
Absolutely.
Pierre and Adam and Dr. Cleary. Thank you very much for joining us.
Thank you.
Absolutely.
Thank you to you both as well. Thank you, John. Thank you, Dr. Cleary.
Maybe ask John.
Okay, John.
John can answer.
Yeah.
First. Yeah.
So, John, last question. Would you rather spend a week in the past or spend a week in the future?
A week in the future.
And why?
I would definitely have to go a week in the future, because there are so many things that are coming forward. As much as I think it would be fascinating to go into the past, go and see certain developments, historical or even prehistory, and see what the world was like, 65 million years ago or something like that. I think that would be fascinating to see some of that. But also, I'm hopeful for humanity, and I'd like to see what we come up with for the future. And I think that we are going to tackle these problems as long as we recognize that that some of this is life and is important. Life is on the line in certain areas. Like, we are in an extinction event, but I think that there are going to be wonderful opportunities, and there's a wonderful opportunity for ingenuity to kick in. So I think I'm very hopeful for the future, and I believe that we are going to solve a lot of these problems. And I do think we're going to solve the climate problem as well. And I'm hopeful for what humanity can develop. So I would love to go into the future and see what we come up with, rather than into the past necessarily, and know where we've been. So hopefully that makes sense.
Awesome.
Thank you.
Yep. Thank you very much, John.
Very thoughtful.
Thanks, Adam.
Thank you.